Welcome to TA Busters, where we test the strategies of YouTube gurus against real data and no bullshit. His strategy was relatively simple. You have some red candles coming down here and you wait for a doji. We all know what one of those is. You enter in the next few candles only if the candle closes above the high of the doji. In this case, it did. He offers no stop losses, no other market context, no profit targets. If it's the reverse, should you want to go short, no other context whatsoever. So I coded it. Sneak peek of the code. Now I needed to come up with some rules. I needed to create profit targets. I needed to create stop losses, or we have no tradable strategy whatsoever. So I made everything configurable and tried it in many different ways. I settled on the pulse flow stop loss because I know this uses previous price action to determine what a good stop loss should be. Profit target, I tested 1-to-1, 2-to-1, 3-to-1 risk reward ratios. Let's run the test. We have some trades. So, did this work out, or is it yet just another YouTuber trying to get clicks? Watch more to find out. Let's go back to ZRO and show a winning trade, a losing trade, a couple of examples of what happened during that backtest. This, in actual fact, was a winning trade. 2-to-1 risk-reward ratio. Let's let it run. Pretty good. But now let's look at context as to why that worked. When you put on order blocks, you can see that it already pinged back into this order block here, gone up to this bearish order block, reversed all the way down and then went back up. Institutional liquidity zones, not just a doji. Let's look at a losing trade. Stopped out almost immediately. Let's look at some market context. Oh, now you can see, can't you? We had a bearish fair value gap with a break of structure. That was going to be a lot of resistance. So when this doji happened here, it was almost at that fair value gap with a break of structure, which was obviously going to get rejected. Now, had you have gone much wider with your stop loss, Pulse Flow is recommending like 12%, hugely volatile coin, you might not have been stopped out, and you would have turned that into a winning trade. Market context. Let's check another one. Stopped out, didn't get to our 2-to-1 profit target. Market context. Okay. Straight away here, I can see that we have a bullish order block below, which is kind of like a magnet. Let's see what Pulse Flow said was the stop loss. Way down. Again, had you have been very wide with your stop here, possibly right beneath this order block down here, to avoid any liquidity sweeps, you may have ended up with a winning trade. But look at the risk-reward ratio. You just wouldn't take this trade. Finally, let's look at this one. This is Home USDT. 2 arrows, you notice. We have a doji, we have a close above the doji, and then we let it run. Now, you didn't get to your 2-to-1 profit target. Maybe you would have got out. But what's worrying me here is, what's the higher time frame trend? We're in a downtrend. We should be looking for shorts. And that's exactly what you did with Pulse Flow. When I store the data of a backtest, I also store if the same coins were traded by Pulse Flow over that exact time frame. And Home USDT is a good example. This one was looking for a long, but Pulse Flow, if I rewind this and move to the 15-minute chart, Pulse Flow had an alert. Back on the 6th of March, bearish signal, tends to drop first, then bounce. Risky play. You get all this market context in Pulse Flow. Now let's turn on our friends. Oh look, we have a bearish breaker block above us. So even though this is a bearish trade, when I'm doing my setup, I would be saying to myself, I want it to come back up somewhere way up here and set my stop up here out of the way. And then my profit target might be this order block below us. Much more market context. Let's see what happens. Came up. Finally hit a profit target. In a downtrend, going short. Using liquidity, not dojis. Let's look at the actual results of the doji backtest. I tested from the 1st of January to March 25th, which is today, 2026. I tested 1-to-1 risk-reward ratio, 2-to-1 and 3-to-1. He didn't say it in the video, so I decided I had to test all three. Let's look at the results. 68.4% win rate. You think that might be okay, right? But only $35 profit over almost 3 months. Let's go to 2 to 1. Lower win rate, 57.9, slightly more profit, 3 to 1. Lower win rate again, and about the same profit, slightly lower. So 2 to 1 was the sweet spot. But look at pulse flow, 75.1% win rate. Market context, institutional money flow. So I have to say, this YouTuber's strategy of a doji reversal is TA busted. However, if you look at a doji which could be liquidity sweep and use that with market context such as order blocks, fair value gaps, then dojis are a possible confluence to add to your institutional confluences. So I'm gonna call this TA salvageable. So the takeaway is dojis aren't a strategy by themselves. They are an indication of a potential reversal, nothing more. And used in conjunction with institutional indicators, they are one more confluence. That's it. Thanks for getting to the end. You can watch one of my videos down here, so please subscribe, like and share, and I'll see you in the next TA Busters. Bye bye.